an escalation of the war in Iran with Israel. What if the U.S. joined the Iran-Israel conflict? And the two-year U.S. government curve is going to fall 160 basis points according to this scenario. Hi, I'm Jan Perula from Extrema. I just wanted to do a quick video for you on an escalation of the war in Iran with Israel. This would test if the U.S. enters that war. So I wanted to see what would happen if we actually escalate that and the U.S. starts to put some pressure on Iran. I'm recording this as of June 19th. So let's see what happens here. So you can see in this window, this is the stress test AI. And I have a pretty well-balanced portfolio here in the background. The point is more about the stress test and what it will come up with than the portfolio. Here's the query that I'm going to give it. What if the U.S. joined the Iran-Israel conflict? So let's see what happens. What the model thinks. So there's a picture, which is actually pretty interesting. I don't know why I like it, but I do. And then here's what we have. We have oil going up, which I think has been pretty consistent in these scenarios where we have a conflict in the Middle East. The models think that oil is going to go up because of supply disruptions, and I don't see why that wouldn't be the case here. And in concert with that, we're going to have S&P 500 energy companies going up. They're going to make more money. The U.S. drilling on the global market will be worth a lot more. Emerging market sovereign spreads, the risk premium of the emerging markets will increase, and this has it going up, 1.5 standard deviations or 238 basis points. And the two-year U.S. government curve is going to fall 160 basis points according to this scenario. And that is in relation to a flight to safety. So we can always go look at the scenarios here and read more about them. Again, it's basically what I just told you, but it's really interesting to see where it gets all the information from, and you can do that within this. Now, one of the things that I will say is that I had to think pretty hard about this type of scenario, and so I went back and I looked at the Iraqi war and some other wars. And what we tend to see when the U.S. is involved is a decrease right off the bat, the market reaction, and then an increase in the U.S. market in particular, and it tends to outperform the other global markets. So if I apply this scenario, you'll see that it's actually going to be a pretty big increase in here. It's actually one of our top increases because we have a balanced portfolio. We have the decreasing, a move away from some of the riskier assets and the sovereign, with the sovereign spreads, but a concentration of the energy and the oil markets doing fairly well. So that's what we have here. Just a quick video to show a different perspective. And again, you are able to add factors and subtract factors from this as you see fit if you don't agree with this scenario. But it's a great starting point when you're doing your research into thinking about what's going to happen to portfolios in different market environments. I'm Jan Perula. Thanks for watching.